Hey, in today's video, we're talking about the RMDs that come from your TSP account. Can they cause you to pay higher taxes? Can they bump you into the next tax bracket? And if so, what can you do about it? That's what we're going to talk about next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees plan for a better retirement. If you need individualized help, go to christycapital.com and click Talk to an Advisor. Some of the things that we help federal employees with is tax planning and making sure you're not overpaying in taxes, because if you let taxes happen by default, and a lot of times, you might just be overpaying. And so for most people, they have a lot of traditional TSP. We're going to show you an example of someone's traditional TSP and what RMDs can come out of that traditional TSP and how it looks tax-wise. In our example, the person has $1.2 million in their TSP and they have just turned 59 and a half years old. And so they won't have to take required minimum distributions until age 75. So there's just over 15 years for that money to grow. And if we don't do any tax planning between now and then, what type of required minimum distribution might there be? So if you look here, this is estimating about 5.5% growth rate along the way. So every year earn about 5.5%. So this person is retiring in 2027, and then the required minimum distributions are happening in 2040. So if you look here, this is showing different income levels at different years. Now the lower line here is 12% bracket, that's in blue. Then the next line going across there is green, and that's the 22% bracket. And then the next line going across is purple. That's the 24% bracket. So you can see that the first couple of years, they're going to be in the 12% bracket. From 2029 through 2039, they're going to be in the 22% bracket. And then you see in year 2040, the big green column there, that's the required minimum distribution kicking in. So they will have Social Security income, they'll have a FERS pension, and then they're going to have that required minimum distribution. And you can see that green column is quite large, and it's actually pushing them up into the 24% bracket. Another thing you can see here is that the green, over time, it keeps growing. So as you get older, the required minimum distribution, it gets bigger and bigger. And of course, the bigger it is, the more taxation happens. You'll see a couple of years out here in 2050, 2053 to 2055, they're actually going to be in the 32% bracket. And so when there's some other taxation happening with non-qualified money, just regular taxable money, it can actually push you up into the 32% bracket. So you can see before required minimum distributions start, income is lower. But once they kick in, income is a lot higher and you're losing control of your income, which means you're losing control of taxation. So let's look at one of the fixes. You could do a conversion, a Roth conversion, maxing out the 22% bracket. So here you can see the yellow bars. That shows doing Roth conversions up to the 22% bracket. And so you can see by doing this, starting in 2040, the required minimum distributions are much lower, but they're still kicking you up into the 24% bracket. So starting in 2040 and after, you'd be in that 24% bracket the entire time. So this is better, but there's still an issue of moving up into that next bracket. You can see over here on the right that estimated lifetime tax savings is around $124,000 by doing these conversions. This is an example of maxing out the 22% bracket, but it doesn't fully fix the problem. What about Roth converting up into the 24% bracket? You can see the yellow bars are a lot higher. We're moving a whole lot more money, and by 2038, you've done it all. You've moved it all. And so at 2040, when usually the required minimum distributions would kick in, you see they don't kick in because everything had been converted to Roth. So from 2039 and out, everything is in the 22% bracket and everything's pretty steady. There's no huge taxation years. Another thing you'll notice since everything got converted is that you don't have a bunch of money accumulating in the non-qualified bucket. And this is money where you can maybe have it in a CD at the bank, money market at the bank, where you're taxed on it each and every year. RMDs cause taxation, and if you don't spend them, you're forced to hold the money in a taxable account. But by getting the money to Roth, you're not forced to take required minimum distributions, and required minimum distributions don't start accumulating in taxable accounts. Over here on the right, you can see there's an estimated $256,000 in total tax savings over the lifetime, just by doing proactive planning. And you can look at the asset values on the right here, and without these strategies, this person is showing that at age 94, they were going to have $3.4 million of taxable money, $900,000 of Roth, and have $2 million of traditional money. And so with the strategies, if you do the conversions and you convert everything before your RMD age, you can see instead you have 0 taxable money, you have 0 traditional money, and instead you have $6 million of Roth. And if you'll notice, the dollar amount is really close. They both have about 6.3 million, but not all money is the same. 6.3 million of Roth means you have 6.3 million. It's all yours. On the other side, without using the strategies, there's taxable money of 3.4 million. And who knows how much of that will be subject to taxation. That depends on the growth in the account. Now, the $900,000 Roth would be $900,000. But then the $2 million of traditional, you don't know what your portion is because you don't know what taxes you're going to have to pay. And depending on what taxes are, well, that'll determine the dollar amount you actually have. So keep in mind, just because they both say 6.3 million, they are not equal. The one that's Roth is better because there's more money in your pocket because there's no further taxation. So this is an example of what required minimum distributions that you will have from your TSP account and what it can cause in the future. And so a way to fix that is you need to shift money from traditional to Roth. And this is something that the TSP does not let you do. You can only contribute to Roth, but you cannot reach into TSP and take $100,000 and move it to Roth. They don't let you do that. And so in today's example, we showed what the fix is. It's doing some tax planning and figuring out the right amount to move that makes sense for you and to fill up certain tax brackets that make sense. And do as much as you can, but not too much. So there's some finesse in doing this, and there's several ways you can mess this up. You could Roth convert so much, so quickly, that you actually push yourself up into tax brackets that you didn't need to go, and it wasn't wise to go. That would be a mess up. But you can also mess up by not doing enough. We saw that the tax savings from the 22% conversions versus the 24% conversions was a difference in either saving $256,000 or $124,000. So one mistake would be, in this case, only Roth converting up to the 22 and not going to the 24. Well, you could have had some more savings if you'd have done it differently. So this is something that we find lots of our clients need help with, and they won't help with. They see the value in doing this. They just want somebody that can help them, and that's definitely something that we help our clients with. So if you need help with this, go to ChristyCapital.com and click Talk to an Advisor. If you're under the age of 59 and a half when you retire and you want to start doing conversions, but you don't know how to pay the taxes without being penalized, check out this video right here, how to pay taxes on conversions using the TSP. I'm Mel Stubbs. I'll see you on the next video.